Hello, my name is John Kornacki, and I'm the financial strategist here at the Federal Home Loan Bank of Boston. Thank you for joining us today for our third edition of our new case study series, this one titled Deposit Pricing Strategies to Lower Cost of Funds. Today, what we're going to do is walk through some of the challenges institutions are facing right now and where we see opportunities to protect against margin pressure as well as optimize cash levels. We're going to focus on deposit pricing and how you can look at retention rates in order to optimize pricing while using the Federal Home Loan Bank of Boston's advance rates as a guide in your decision making. We're going to start off by looking at cash build over the last 4 quarters. As you know, the Fed cut rates to 0% in the middle of March, and market volatility spiked at the same time, with spreads widening significantly and uncertainty reaching highs. As you can see at the end of March, our members started to take a defensive position and bolster up liquidity. And then as you see in June, that level spiked up even higher. With few options on the asset side of the balance sheet and the prospect of continued loan runoff, we have to ask ourselves, what options do we have to preserve net interest margin? As you know, it is expensive to hold cash right now, so our members will face continued pressure in earnings and interest rate risk in the current environment. Even with increased cash levels, many of our members still have a very high reliance on CDs. As you can see from this chart, the median level of CDs as a percentage of total deposits is 22%. Looking at the current environment with loan to deposit ratios significantly impacted by the influx of liquidity and loan growth slowdown, where should our members be pricing CDs? This is a question that all members should ask themselves, especially if your situation matches the one I just outlined. There is a risk in pricing well above market, and if you don't have a plan for that cash, it will only eat into your margins. We're going to take a look at a model that was developed by our team at the Federal Home Loan Bank of Boston. We'll focus in on some of the key inputs as well as interpreting the results. We first take a look at institution-specific data, loans, assets, deposits, liabilities, and capital. We then look at internal loan to deposit limits and excess cash. Every institution has a set limit on their max loan to deposit level, depending on their board's comfort and strategy. For the purposes of this scenario, we set the limit to 105%. In terms of excess cash, this should be a level that your institution would be comfortable running off. As I mentioned earlier, with increased cash levels and few options on the asset side, there may be some cash runoff that you feel comfortable with that would help bring your liquidity position to a desired state. Next, we're going to look at key assumptions that go into liability pricing. First, we need to determine a pool of deposits that will be repricing in the near term. In this case, we're looking at 12-month CDs. It's a $15 million pool with a weighted average rate of 1.5%. Next, we need to determine how we will price the maturing CDs. If you look at the updated rates section, which shows low and high offer along with their respective retention rates, this is where we can run sensitivity analysis by adjusting these figures. For example, if you look at the chart, if we priced our CDs at 50 basis points with a retention rate of 80%, that means 12 million of the maturing CDs will roll into the 50 basis point product. We will talk about what happens to the other 3 million shortly in a few slides. But this is really the core of the analysis. Each member needs to take a look at their customer base to determine likely retention rates based on the input rate. Based on recent flight to quality trends, we may be able to assume higher retention rates for what we've considered low offer rates, just because many customers want to house their cash in secure, risk-free products right now. We also have the ability to stress these assumptions as well to see what the impact would be if there is higher than expected runoff. A scenario can be used for a worst case scenario. Moving on, the last part of this chart, we look at runoff replacement through the Federal Home Loan Bank of Boston advances. For this case study, we're going to replace our 12-month certificates with 12-month FHL Bank Boston advances at 37 basis points. Depending on your liability strategy, or if you're replacing 12-month CDs for 12-month advance, for example, this field is custom to allow any term along the curve that fits your needs. This chart is looking at the FHL Bank Boston advance curve at the time we ran this case study. As you can see, there is some advantageous pricing at the 12-month point on the curve. The advance curve can be used as a guide to help price deposits, and with so few options on the asset side of the balance sheet and having wholesale funding as a low-cost option, there are very few reasons to price above the advance curve right now. We're now going to start to examine the results. The first chart we're going to look at is cost of funds impact through offer rate sensitivity. Essentially, we're looking at how much we can save through examining each offer rate and retention rate assumption. For example, if we offer 10 basis points on our repriced CDs, we can expect to save 20 basis points in cost of funds. However, we have to remember the constraints in achieving the savings. In our original assumptions, we set the loan to deposit max of 105%. This means that we cannot allow our deposits to run off so much that it would breach this limit. Therefore, in taking this limit into account and by looking at the yellow dot, we can see our max cost of funds savings through an offer rate of 20 basis points. So we're looking at another view to see how our offer rate sensitivity impacts our loan to deposit ratios. As mentioned in the previous slide, we see that at 10 basis points, we breach our limit with a loan to deposit ratio of 106.51%. And with our max savings given our loan to deposit limit, we achieve that savings with a result of 104.2%, which is below our set limit. The last piece of this case study that I want to review is the total impact in terms of specific numbers that the model outputs. If we focus on the highlighted box and the corresponding row of data, we can see the breakdown that results in the maximum savings to cost of funds. In the deposit summary, we retained 43% of maturing CDs at 20 basis points. Also, if you remember, we stated that there is 2.5 million of excess cash on the balance sheet. Therefore, we only replaced 6.1 million of the excess runoff at a cost of 37 basis points. In total, the deposit balances and advance balances equaled 12.5 million, which is the original 15 million less the 2.5 million of excess cash. If we continue to follow along the same row, you can see that with the repriced deposits and new advances, our new blended cost equals 28 basis points, which equates to a total cost of funds savings of 19 basis points while still achieving our loan to deposit and liquidity goals. So in summary, this low rate environment is placing extreme pressure on margins, and with stunted loan growth and unattractive investment yields, lowering cost of funds is the clearest path to margin relief. With all of this excess cash, we can use that to test deposit elasticity and lower deposit rates below advance rates. And in the event that cash runoff is higher than anticipated, advances act as a support to low cost funding and still achieving cost savings goals. Overall, this model and case study can be used for your institution to discuss internally as well as with our strategies team to help mitigate margin pressure through these uncertain times. This is all for our presentation today. Hopefully you found some value in walking through this case study with me and took away something that your team can discuss as you work through your balance sheet management process in these challenging times. So this recording and PDF version of the slides are available on our website, along with the other case studies, webinars, and articles we've written. Um, and if you have any questions, feel free to reach out to me or your relationship manager, and we'd be happy to help out in any way that we can. So thanks for listening today, and have a great rest of your day.